Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex. Chicago soybeans. 5 weeks ago, the market broke above the highlighted in purple late July to late August bearish shift pitchfork. 4 weeks ago, the market approached its first real test overhead. That was the flatlining short medium moving average, currently at 1330, highlighted in green on my daily chart. This was not that heavy a resistance, though it did do a good job of capping the market back in late August, then again 4 weeks ago and 2 weeks ago. At the same time, short moving average, currently at 1347, started to provide some support, though I personally at the time did not think that support was that extensive. Eventually, prices were pushed up through the short medium moving average with the middle of 3 consecutive daily bullish opening white marrow bozos. That same day, that's 2 Fridays ago, prices also punched up and closed over the recent 50% Fibonacci line at 1349. The very next session, so that was 2 Mondays ago, the third of 3 bullish white marrow bozos went up to challenge the next overhead resistance, the flatlining medium moving average, currently at 1362, and I highlighted in mauve on my daily chart, piercing it but also capping it, though only on a closing basis. Then over this past weekend, we had a gapping higher move with a clear close over the medium moving average and up into a congestion band between 1378 to 1409 that contains a slowly declining long moving average, currently at 1391. That is highlighted in gold on my daily chart. I had spoken about this band in earlier times, as back then it had contained the base of the earlier late 2022 descending triangle at 1378 and the lesser Fibonacci line at 1409, both exceptional levels in the past. Prices punched up through the long moving average midweek but ended the session with an indecisive doji cross and ultimately only the one close over the long moving average before coming back down to where we rest now, in between or just under the medium moving average. Overall, it would not surprise me to see another attempt higher to test the long moving average again, despite the failure to secure the market above it this week. But I am also mindful that the small gap below that sits between 1349 and 1349 and 3/4 to be exact, and 1350 and 1/4, and perhaps there is now a desire to fill it first. Chicago soybean meal. 5 weeks ago, the market broke above the highlighted in purple late July to late August bearish shift pitchfork. Now, there was no weekly key reversal up here 5 weeks ago as we saw in soybeans. That did not mean it was immune from the effects of what happened in soybeans. No. We saw this play out when prices punched up and closed over the upper tine of the bearish shift pitchfork, the short moving average, currently at 405.60, the medium moving average, currently at 410.10, plus the 50% Fibonacci line of the October 2021 to March 2023 move at 403.60. These all became supports. Then there came a pause over the last, towards the end of October, as the market gathered strength around the lesser Fibonacci line at 415.5. for what was then the next big assault on the upside, and that was the slowly declining long moving average, currently at 424.60. Until 2 Fridays ago, when prices punched up through and closed over the long moving average. This was swiftly followed by a move up over the interesting neckline of the old December 2021 to June 2022 head and shoulders top, currently at 437.40, which is highlighted in dark blue on my daily chart. Now you would think, hey, this is a pretty good move higher, and a hesitation of 2 and 3 weeks ago. Well, that could be a halfway hesitation. And we may well see a move higher for this bullish halfway hesitation up to the 460-65 area. In that case, you would be right. We saw an initial foiled attempt higher, foiled by the resistance evident from the July high at 451 even, but then a renewed move higher that finally last Wednesday reached the 460 to 465 area, if only just. Prices have since then tested back down towards the thick blue neckline and bounced back up, no doubt prompted by some longs taking money off the table and re-establishing the longs themselves lower down at a better average. So what now? Well, we have the makings this week of a possible horn top. First decent piece of topping action free from any nearby resistances, so that is something to note. However, I would echo again some of my thoughts from last week, and they are not only valid but quite extended. So here goes, and I quote: "You would need to have a fall with consecutive closes below the long moving average to dent this drive higher, and consecutive closes below the medium moving average to really start thinking bearish thoughts about this market. Additionally, in the background is the fact that October was a monthly key reversal up, something not to be taken lightly. Finally, this brings me once again to a point which I raised 23 weeks ago, so that is now 24 weeks ago this week, to a point I raised 23 weeks ago and which I will keep raising for the rest of this year at the very least. You see on my long-term monthly charts, as we enter the 11th month of this year, 2023 is set to possibly be an annual key reversal. Thus, if we were to close on New Year's Eve either above 471 or under 399.10, then we'd be on. Anything in between and would have a lesser outside year. Now, right now we're looking at an annual outside year, but whilst we still have time to change that, the sands of the hourglass are rapidly emptying and time is running out." End of quote. Chicago soybean oil. The late June to mid-August head and shoulders top with an extension handle, if you like, on it, led to the latest key pattern here. Initially it was a descending wedge pattern, which over time became a bear channel, highlighted in dark blue on my daily chart. This market, much as soybean meal, was not immune to the weekly key reversal up made in soybeans itself, and tried to turn a test lower early 5 weeks ago into a break up over the upper trend line. But it was not immediately successful, or rather its only success back then was to turn the original descending wedge pattern into what you see now, a bear channel. In turn, this does not mean that the upper bear channel line was not immune from being challenged, as happened all of last week, but it was only this week that prices verified this move higher and finally broke up and clear of the bear channel. Now, this constant challenge over the last few weeks was due to one factor, and that was in some ways surprising, but it was the 38.2% Fibonacci line of the big March 2020 to April 2022 move at 48.95, which stood immovable on a closing basis sitting below. As I said last week about the situation, I quote, "This cannot last, as by the end of tomorrow," so that's last Friday, "at the end of tomorrow, the upper bear channel line will cross the 38.2% Fibonacci line and something will have to give way." Last week I said how I didn't think this 38.2% Fibonacci line looked that strong. Well, it has been much more formidable than I anticipated, and I'm very curious to see which gives way. If the Fibonacci gives way, then we may not have that much support below until the lower bear channel line. If the upper bear channel line gives way, then we do not have that much overhead apart from the March 2013 high at 51.26. And I have my doubts on being able to handle any strong reaction move back up, which such a break might generate. You might have to look at the February 2013 high at 54.15 to see some decent resistance should this happen. End of quote. Well, prices punched up through the March 2013 high, but turned back lower almost immediately and didn't even try to reach the February 2013 high. Not yet, at least. Instead, the market has pulled back to just under the March high and just over the flatlining short moving average, currently at 50.65, as if it is waiting for something to happen. What I can do in the meantime is lay out some potentials for the break higher from the bear channel. Thus, a primary target X for such a break would be in the 57.85 area, in amongst the load of congestion between the 50% Fibonacci line of the March 2020 to April 22 move at 56.34, up to the lesser Fibonacci line at 59.79, and sitting a little over the declining long moving average, currently at 57.15. Whilst a secondary harder to reach target X1, indeed a lot harder to reach target X1, would be above all the moving averages and a whole load of congestion up in the 62 even area. It would be fair to say that right now I have reservations about the market reaching target X and severe reservations about it reaching target X1. Finally, and this refers to an earlier statement about the larger descending wedge pattern seen at the start of this year, where I said the following some 20 weeks ago, and I've since also done so on every opportunity, and I quote, "I would consider this descending wedge pattern may just may, have lately morphed into a possible scallop pattern. End of quote. Now, I will not expand on this idea any further at this time again, as it is a big pattern idea and is also still early on. But the recent market decline fits in with this idea, and the expectations I voiced of eventually witnessing a fall down to the area of May and June lows between 48 to 46 zone, which we have just about done. Well, I'm now keeping a close eye on this idea, as any significant breakdown below 48 to 46 area would signal the start of this move lower, and likewise any reversion back to the peak where we have the head and shoulders pattern exists, well, that could signal the alternative break upwards. Two things to bear in mind. Firstly, this is a really big pattern stretching from November 2022 to date, so do not expect any immediate sharp movements. Secondly, data indicates that about 3 out of 4 times the market breaks lower. This doesn't mean it will be here, but please just be aware of that. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.